Today on the show, I have the great pleasure to welcome Tony Buckle and John Carolin. Hi.
Hi, Phil. How are you doing?
Excellent. And you, John?
Very good to meet you, Phil. Very happy to be here. Thank you.
Excited. Tony, you were Chief Underwriting Officer for Allianz Global Corporate and Specialty. You've been working in the industry since 1996. John, you've been the CEO of B3i, and you've been a technology venture builder, finance professional, chartered accountant. And I understand you have a very interesting family background.
I am a permanent resident in Switzerland. I've spent about 11 years of my professional life in Switzerland, but I was born in South Africa. However, I'm an Irish citizen. My family immigrated initially to the UK and then to New Zealand about 23 years ago. My sister, my parents are all New Zealand citizens, so we're all a bit of a mixed bag. My wife is Czech. My 6-year-old son was born in Dubai, and then my youngest was born in Switzerland. So we're a real mixture in this family. Any given day, there are 3 languages spoken in the house. My mother's closest sister was South Africa's second female actuary 30 years ago.
So today I would like to pick your brains on the digital transformation of insurance. And Tony, you have a strong experience in this area. You've been a CEO in Allianz, in AXA XL. What is a CEO? What is a Chief Underwriting Officer?
The Chief Underwriting Officer effectively oversees 3 essential processes in an insurance company. First is the evaluation of exposures, risks. The second part is to define the appropriate coverage with the client and the broker for that particular exposure. And then thirdly, to define and indeed negotiate the price for the risk transfer. So those are the 3 essential tasks of the underwriter.
So do you walk around life looking at everything through a risk glass?
I try to keep my personal life and my professional life quite separate, right? Which I know maybe is a little bit passé, but that's certainly how I look at it. But I think you can't help, when you're assessing exposures for a living, to look at things in all aspects of life through that risk lens. And yes, you do end up sort of worrying about the way that certain things are being done, for example, on the grounds that if they were a risk that you were underwriting professionally, you'd be certainly worried about taking that risk on.
So you live in Switzerland too. If you go skiing once in a while, do you think about your risk profile?
Well, I've got 2 young sons, so I think about their risk profile an awful lot, actually, yes. It's interesting, the evolution of your skiing with your family. So you start with them, in a sense, trailing you, and you're worried about things such as, are they actually going to be all right, or are they just going to sit down, and is the problem going to be getting back to them? Then you have the issue, of course, that they sort of get much more confident and much more competent, and then they're sailing past you, and often your problem is then catching up with them, in which case the exposure changes quite dramatically. Yeah.
You worked in risk solutions, corporate solutions for several companies. What do you mean with solutions?
Maybe it's worth taking a step back. My background is much more on the sort of commercial and corporate insurance space. So I haven't spent much time in my life doing what they call personal lines insurance. I've been dealing really with business to business insurance as opposed to business to consumer insurance. In that area, the coverages are often very bespoke, Philip. It's not a question of a standard product. It's a question of a client. All commercial clients, frankly, are pretty unique. And your job as an underwriter is to define an appropriate coverage for that client. And obviously that's a 2-way process. The client will say, this is what I'm particularly worried about. This is where I'm growing. So I now need to think about taking on new exposures here. And can you accommodate that in the coverage? So it's fast moving. It's a fun area of the world because clients don't stay the same. And of course, you're dealing with 2 major variables. One is the client doesn't stay the same. And the other one is the environment doesn't stay the same. And obviously with climate change, inflation, social inflation, litigation trends, it certainly keeps you busy trying to keep abreast of all the exposures and keeping that coverage relevant.
So for our viewers and auditors who are starting in the insurance world, could I summarize that saying like you have the B2C insurance, like where you sell insurance to a family, for example, and what you were doing was B2B, selling to big companies where you had to understand much more risks, understand the company that was much more complex, and that's what you call a solution. Is that the correct summary?
Yes, I think a solution tends to be more crafted and tailored. So there's nothing to say that you can't have tailored personal insurance. But frankly, most people going, for example, onto a price comparison site for their auto insurance are buying a relatively standard product. They might adjust 2 or 3 variables, but effectively it's a standard product. often with a corporate client, you're starting almost with a blank sheet of paper because their exposures, their global footprint, their processes, their needs are going to be unique to them. And therefore, you need to start with a very open mind as to what the exposures are, what the coverages can be. And in the end, you need to work out an appropriate risk price.
So that means you have a lot of things to analyze, understand from different industries. That might be quite an exciting job, actually.
Yeah, I was at a drinks party probably about 15 years ago in the UK. And I was speaking to somebody about what I did for a job. And I didn't mention the dreaded word insurance. I said, what I do is I evaluate risks and I describe the sort of risks I was involved in, which at that time was mainly project insurance. And I said, we try and work out, what could possibly go wrong with these types of risk. And then we sort of come to an agreement with the client over the sort of coverage that is appropriate and obviously an appropriate price. And I can remember my counterparty at the drinks party saying, wow, I didn't know such fascinating jobs existed. That sounds really great. I'm thinking about recommending that to my son. He said, well, who do you work for? And then, of course, I mentioned the insurer word. That is one of the things we have to get away from in our industry. I think that a lot of people come into insurance by default. They haven't actually strategically aimed to come into insurance. They sort of end up in the industry. And a lot of people associate insurance with buying car insurance. And it's only when you're inside the industry you realize the fascinating world that it is. And it's a real world of ideas. What we're selling at the end of the day are promises. So it's very theoretical, but at the same time, it's really in the real world. Someone who's fascinated by current affairs, by technology trend, by what the future will bring, I think could be much worse advised than going into insurance. I think it's a fascinating space to develop a career.
Yeah, I agree with you. And you can touch anything that humans do, actually, contains risk and thus has a link to insurance. But you're talking about also the trends and evolution. You were working with a B3i. That was a global initiative, basically for digital transformation of the industry. Can you tell us more about that? What was it?
It was a really interesting environment. One needs to sort of look back to understand B3i's place in the industry. We've spoken a bit about large, complex corporate risks, and then reinsurance is really wholesale insurance of both personal and corporate risks. And the exchange of data related to those risks, the transacting of those contracts is very, very complex. On what's called natural catastrophe reinsurance treaty, on average, you have 30 reinsurers on one program. The risks are too large for any one person to take them. So, and what you really have is risk being sliced and diced many ways, shared between multiple parties. And that's extremely administratively intensive, and it's only getting more complicated. So if you step back and you look at the insurance industry, of the 100% of premiums that you're paying, the bulk of them are used to cover claims. But unfortunately, a large part of them also go towards administration. So the most efficient reinsurers have high single digits percentages of premiums being paid towards administration. The less efficient reinsurers, it's starting to get into the teens. And then you can have commercial insurers where it's 25% of the premiums are getting paid to administration just because of the number of parties, the complexity, the amount of data. And this is something that's getting worse, not better. So if you look at administration costs as a percentage of revenue over the last 20 years, there was an interesting study a few years ago by McKinsey. If they compared telecommunications, automotive, airlines, and insurance. And in all of those industries, with the exception of insurance, administration as a percentage of revenue is going down. In insurance, it's going up. And this is a challenge that the industry has always had. So you can go back to the 1980s. There was something called LIMNet, the London Insurance Market Network, and ReNet, sponsored by IBM, that were looking at electronic data interchange to seamlessly integrate participants in these very complex, highly connected networks. I remember seeing articles from the 1990s that spoke about how email is going to reduce the amount of paper and the frequency that people need to get on flights, and how this is going to reduce the administration. So B3i is part of a long lineage. There's the Rishlikon initiative, which has worked to increase the adoption of the Accord messaging standards. All of these are initiatives that have existed with the aim of reducing admin, spending less money on wasteful administration so that more premiums go towards claims, better value proposition for the industry towards its customers. So B3i was born through many of these same parties that have worked together for decades on these problems, coming together, catalyzed by new technology. They started looking at blockchain because inherently blockchain is this network technology. It is a team sport where you come together to solve common standards, infrastructure, and protocol problems. And B3i was initially an innovation environment where they were testing out the technology, but many of these people have their lineage in these other initiatives. And it had some initial success while it was still a very loose consortium testing out the technology around building proof of concepts. And that was in about 2016 and 17. And off the back of those proof of concepts, the industry decided to fund a venture to build common infrastructure and protocols to really bring the administration and the exchange of data across this highly connected network into the modern era and enable more relevant insurance products for an evolving risk landscape.
So was the blockchain the key element of B3i, or was it just one of the new techs you wanted to try?
That's an interesting question, because after the setup of the entity, the board debated the idea of changing the name because there was too much blockchain in it. And this wasn't about the technology, this was about the outcomes.
Does the B in B3i mean blockchain?
Yes.
Okay.
Yes. The genesis of the name is the Blockchain Insurance Industry Initiative, B and 3 I's.
Okay.
And once the problem statement was clear, there was a strong feeling that was what we should be known by, not by how we solve the problem. The technology really just being a tool. But there were many, I would say, stakeholders within B3i, and there were many that were interested by the technology and were technology evangelists. As we matured, the question I asked of my team was, what is the best technology for the problem that we're trying to solve? And by best, it wasn't the shiniest or the newest. And frequently when you ask very smart engineers that question, what's most interesting from getting A to B, isn't the one that's most effective. It's the one that they can learn the most. They have inquiring minds, so trying new tools and building out your toolkit is very interesting. But we over time really looked to distill what made sense for blockchain and what didn't.
Did you find some special use cases? Because you didn't go from tech initially. You said, hey, here are the use cases for the insurance industry, and then you went and looked for the right tech.
Yeah, it was an amalgam of those. We inherited technology in insurance and in blockchain. There are some classical problems that blockchain lends itself to. That's sort of quite top-down thinking when we think about multiple parties with untrusted parties exchanging data. That's a classical blockchain problem across any industry. But I think looking through the lens of technology can be quite problematic. And this is a point I've reflected a lot on, because technology is just a tool. You can bend technology to do wonderful and fantastic and almost anything. One needs to ask yourself not what is possible, but what is probable. And if you want to understand what is probable, you need to think about what is desirable and for whom. The whom is a very important question because there are many people that are impacted. So who are the winners and losers? Are the winners empowered to overcome all of the barriers to adoption? And technology sort of starts to disappear into the background when you think about those more pressing questions. So it was one of the first things I looked at B3i was to look at everything that had come before. Why had it succeed or not fully lived up to expectations? There's some themes that come through again and again, and who benefits from change and who doesn't benefit from change. Within the industry, economic value isn't accruing to all participants. And equally, there are winners and there are losers.
That's in any industry. We see blockchain now appearing in luxury, in fashion. Why should it be different in the insurance industry?
I don't think it is. Let's step out of insurance. A perfect example related to blockchain is cross-border international money transfers. Instantaneous T0 international transfers have technically been possible for a long, long time. It's not that we need new technology to do it. The reason it hasn't happened is because banks can make money on the overnight market into bank lending if they take time to process those payments. And there's been no threat from outside entrants. Technology, DeFi solutions are starting to force banks to change, and the banks want to change because they want to keep their customers. So it drives change, but it doesn't mean that the people building those new DeFi solutions are going to win in that space. They're up against some very, very powerful adversaries.
Some new banks like, the Revolut, they do these
Yes.
transfer right away, and they do take some market shares. I see a lot of my friends going on to these banks.
Yes, I think this idea of sort of creative destruction, organic disruption, is how a lot of change happens. It doesn't happen because people want and orchestrate it. It's very difficult for industries to coordinate themselves with legacy. It's much easier to start with a blank piece of paper when you want to disrupt. I'm really interested within the insurance sphere to see how there are a lot of intermediaries, challenger brokers that are investing heavily in technology, and it's interesting to see how within the insurance and large commercial broking space, some of the very aggressive new brokers have the potential to win market share and bring about the same change, but in a less orchestrated way.
So the change does not come from the industry itself in this case, but it comes from new companies, startups, insurtechs that orchestrate that change. Is that what you're saying?
Yeah, that's one pocket of the change. It comes from the incumbents as well. We need to not paint with a broad brush here. There are a lot of really interesting things that incumbents can do with their customers that technology can enable: real-time assessment of risk, real-time underwriting of risk as dynamic risk changes, around this concept of embedded insurance, where the insurance is just part of a service being offered. I think there's some really interesting stuff. But what you have with a single incumbent forging a partnership with someone else is a strong competitive advantage that gives you. Where you have an industry working together to lay common infrastructure and common standards and protocols, it's quite difficult because it doesn't create individual competitive advantage, or certainly sometimes the people who are funding it, the larger incumbents, are putting themselves at a disadvantage because there are others that can benefit from their investment, and they're already quite efficient. Why should they make the smaller players more efficient because they solve the common problems? So there's some really interesting competitive dynamics that happen when cooperative competitors with different strategies come together to solve common problems. And often those common problems don't have a user interface. They're standards and protocols. They're just part of a stack. That's sometimes really abstract and hard for people to understand what you're doing.
So Tony, you both work with digital transformation in the industry. Would you say that it's a slow industry to embrace technology?
I think there are factors that make it more reticent about technological change than maybe other industries, Philippe, right? So let me name two of those. Firstly, there's an awful lot of legacy architecture out there. And it's tempting just to say, well, why don't we just turn that legacy off and move on to the cloud or some other platform? You've got to remember that when you do that from a finance perspective, you have to take an awful lot of amortization to the bottom line immediately.
It's expensive.
That's very, very expensive. So there is a big industry issue around stranded costs from legacy systems, okay? The second one is regulation, of course. Regulation, the industry is rightly regulated. We don't want to have a situation where these promises we talked about earlier cannot be fulfilled when they are due. At the same time, regulation means that everything that we want to change has to be carefully considered and governed and compliant and everything, which, of course, is right. But compared to other industries which potentially are less regulated, it means it just slows the process down. So I think we have to accept that is two preconditions. That said, there is a lot of innovation in our industry. I think we sometimes sort of say, well, as John said earlier, let's not get too broad brushed here. There is a lot of innovation going on in insurance. A lot of it is really clever.
What kind of innovation?
John has mentioned one, embedded insurance. You can embed insurance now with almost any purchase that you make. And I think that we've only started scratching the surface on that. There's huge opportunities for companies to start looking at how they can use insurance in a product enhancement way. So let me give you an example of that. I go on holiday. It rains a lot when I'm on holiday. Wouldn't it be nice when I got back home, there's a check for me waiting that says, when you went on holiday, it rained an awful lot. And as part of our sort of service as a hotel, we appreciate your holiday was probably dampened a bit by that. So here's €1,000 to come back again, right? Now, you can probably work that out quite quickly. You just have to say, well, there's a parametric out the back that enables, if you have 5-7 days of rain during a 14-day period during the summer, then, that's unlikely to happen. So we'll just basically make that part of the embedded product, the total cost. But obviously, the customer gets a very specific upside if that event comes to pass.
So I'll book my holidays in London.
Actually, London, you've got to remember, this is where the sort of understanding of exposures is sometimes quite different from people's popular perception. London actually has significantly less rainfall than Zurich.
Oh, okay.
So,
you're teaching me that.
London is actually a drought city. So the bigger peril in London you have to worry about is drought than you do about rain.
Okay.
That doesn't mean they can't have rain. And of course, they recently had very torrential summer rain. But of course, it's not, in a sense, good rain. This is rain that goes very quickly into surface runoff, leads to surface flooding. So you get flash floods as a result of that. So it's not useful rain in the sense that it can be sort of easily managed within a water system and used for the common good. Yeah, there's a whole load of things, Phil, around innovation in our industry which need to be sort of carefully considered. But I don't like this idea that insurance and insurers are not innovative. They are. What we want to do is make it a bit more mainstream and a little bit less marginal.
Do you have a second example about innovation in the industry?
Sure. I can give you an example of something that we did at B3i. One of our customers enjoys that solution, and it's another embedded insurance solution. So it's one of our former customers that has partnered with a vehicle manufacturer. And if you look at the mobility space, there's this idea of mobility as a service. Instead of owning a car or even just leasing the car, you have a service which provides you a car. So more than just leasing, but really someone provides you a vehicle, that vehicle needs repairs, you get swapped out for a new vehicle. You never really worry about the ownership. Many insurers have partnered with manufacturers because of this trend and data that they get. If you have mobility as a service, well, you shouldn't then need to take out insurance on that. So the insurer has enabled the manufacturer to embed insurance in the vehicle. You are insured, the vehicle is insured. If you have an accident, you go to the local dealer, they'll repair the vehicle, get that vehicle or another one. You don't know that behind that there is a regulated insurer that has taken on that risk. And your experience is with an application that is branded with the name of the vehicle manufacturer, but behind that, through a network of connections, the claim is being administered by the regulated insurer that is an entity that is regulated to underwrite motor risk, and so the insurer disappears in the transaction.
I see. Two things. It seems first that talking about globally, the sharing economy, so I could see a big potential there for that. And the second one would be, it also can be a challenge for the brands.
Insurance has a challenge, and I'm stepping into the personal line space. We want to know that our insurer is well capitalized, that on a rainy day, that it can pay its claims. But people feel a much stronger affinity towards their consumer brands. So when you go and buy your new iPhone and they offer you an extended Apple Care warranty, that point where you buy the iPhone, it's nice, it's shiny and new, is the day that you value it the most. The day that someone offering you to protect it, you're most likely to accept that. You're not going to go home later that afternoon and think, is there an insurance company that can offer me a product that's going to replace my cracked screen? But if the salesperson at Apple is offering it to you, you have a much more likelihood of selling that. Now, that's an insurance product, not an Apple product. It's not that Apple's necessarily underwriting that risk. And so insurance has always had this insurance is a grudge purchase. We buy it because we have to. We buy the life insurance policy because the bank, when they give us a mortgage, tells us we need cover. We're reluctant to buy insurance by and large. And embedded insurance is leveraging the existing distribution networks for products and services where people value what they're buying at the time that they value it. It's a way of changing that insurance is sold, not bought. No one goes out to do it, but now let's make it convenient for you to buy insurance.
But to get the risk of having basically your brand disappear in that case.
Any insurer has multiple distribution channels. They'll have tied brokers in the UK. You've got the aggregators, the comparison websites. In the last decade, you can't ignore them. That's where the bulk of motor and household insurance is sold. So I think one's got to really develop a multi-channel distribution approach. And embedded insurance is a place where you can sell insurance. It's where, for many lines of business, it's the only place that you will sell that insurance. It's not your brand that sells it, but there are other products where people value the brand more rather than the cover. You would focus on other distribution channels.
I would agree, John. I think that, Phil, to your question about the brand disappearing, two thoughts on that. Firstly, white labeling in insurance has been around for an awful long time. So you might even think that you're buying your insurance from a supermarket or buying it from a famous brand of some sort. Of course, behind that is actually an insurance company. So that is effectively white labeling. That's been going on for an awful long time in the industry. I don't think that's worry. Secondly, I think if you're looking at a lot of insurances, there's two sales. There's the B2B and the B2C. So I think that the fact that the purchaser of the program recognizes the insurer. So the B2B relationship, they recognize the innovation being brought by the insurer. It doesn't necessarily then matter that to the end customer, that insurance arrangement is more opaque. I think what matters is that the essential purchaser, the first mover in the relationship, is recognizing the value of the insurance and indeed the insurance brand.
So basically what could happen in a sharing economy if we go longer that route, as John was explaining to us, the actual clients, the people who should be aware of these brands, are the people buying insurance from companies, the B2B purchase departments, instead of the end users.
Yeah, as we progress in the sharing economy, the insurer on the B2C front will be more looking to the embedded type arrangements. It's a sales enhancement. And so I think that we will see that the brand probably less immediately obvious. Of course, it still matters. When you're in a claim situation, which is when the rubber hits the road, you recognize pretty quickly you're dealing with an insurer out the back, which I think is as it should be. But at the same time, the industry's got to move with the times. The innovation, the exposures are evolving, and therefore the industry has to react to that. And if it can do so via a third party who's actually, in a sense, driving that value in their sales process, so be it. I think that's a good thing.
So now you both created a company together. UWX, what do you bring to the industry?
Well, what we are trying to do with UWX is really focus on the chief underwriting officer of the insurance company. Obviously, there's a lot of consultants involved in the industry, and they do a very good job. There is, from my experience, a bit of a gap within that sort of consulting service, with people who really understand the needs and pressures on the CEO. And the CEO has often an obligation, a set of goals around the company's performance, about loss ratio, the cost ratio associated with that, volatility, variance, compliance, governance. And as industry insiders and as people who've actually been responsible in those sort of roles before, we can not only offer, we hope, a more appropriate sort of set of consulting practices, but also we can get up to speed very quickly. So we don't have the ramp up. We understand, hopefully, the issues very quickly, and then we can move much more adroitly to helping the client, partnering the client as they evolve solutions.
Let's say you go to this big insurance company. The CEO says, hey guys, can you help me, please? I have problems. What is the first thing you would do?
You've got to do an awful lot of listening, Phil. I think one of the big things that we are really, really strong on is that partnership starts with an awful lot of listening. You've got to understand what the problem is, okay? The fact that listening is a very active process. It's not a passive process. The fact that we understand a lot more about the industry maybe than some others means hopefully we are better listeners because we don't have to seek all the clarification, but maybe others who are less experienced, I suppose, in the industry have to ramp up on. But that doesn't mean that we can come in and wave a magic wand. Well, our job is very much to listen, to understand the issues, to probe, ask good questions around what those issues are, what are the consequences of various different outcomes, shall we say, from those issues, and then start partnering with the CEO on appropriate responses, which sometimes are very urgent. There might be an acute need. So, for example, if a portfolio is just tanking and losing money, you need to stop the bleeding. That's the sort of same process as you'd have in an accident and emergency room. You've just got to save the patient. Then you obviously would move into a more strategic discussion about, do we want to go back to first principles here and actually work out exactly what are the exposures we want to cover and make sure that you sort of build a solid foundation for the go-forward underwriting. And of course, that itself leads to interesting questions for the technology setup of the company, because you want to underwrite in a state-of-the-art way, and you want to make sure you're taking advantage of the latest trends and the latest opportunities that are afforded by InsurTech, and most importantly, I think, external data.
So how do you do that? You go into these companies, you ask for your help, and he says, hey, look, my portfolio, it's not working. How does one proceed with that? I'm not an underwriter, I'm not a CEO, so how do you proceed?
Well, I mean, it's an interesting question. My portfolio is not working. What do you mean by it's not working? Do you mean it's not, the loss ratio is too high?
For example.
In which case you've got a basically underwriting technical profitability issue. You could have a situation, as John has very clearly articulated earlier, that you've just got a cost ratio, an admin ratio that's just way too high, in which case you've got to address your cost issue. You might have a volatility issue. You're potentially very profitable 4 years out of 5, but your 5th year absolutely kills you. And therefore, you've got to look at your volatility on your portfolio. What's the variance here? You could also have issues around compliance and around governance, and having a regulator on your back and saying they don't want that. And those regulators can be, shall we say, official regulators or more industry regulators, think Lloyd's. And therefore, you've got to get into that. What is killing my portfolio? What's the actual problem I'm trying to solve here? And what we try to do within our world is actually try and frame that problem into bite-sized chunks. So we actually say, well, these are things we need to talk about in this dimension. These are things we need to talk about in that dimension. These are things we need to talk about in the third dimension. And then start coming up with sort of priority orders in terms of how we would address those problems. My guess is if your loss ratio is at 150%, that's probably a more acute issue than solving your cost ratio at 40%, because ultimately your loss ratio is geometric and your cost ratio is arithmetic. So I can take it down, but I'm not going to take it down by 50%, right? So I think that's where you can have very logical and good conversations around prioritization of intervention. And that has been very important over the last few years, as particularly in the corporate and commercial space. People have recovered from what has been a pretty long and deep soft market.
Yep.
Just flipping it around at the moment, Phil, we're getting a lot of requests around growth. So people are now saying there is an opportunity in the market. Can you help us address this area of opportunity where we don't necessarily have the experience in-house? And our job can be anything from helping them establish an underwriting strategy through to, frankly, team and strategy. So bringing the whole thing together and sort of saying, well, this is how we would take it forward, and here are some good people who could potentially help you with it.
So how do you split the work between the two of you?
We're a team. We have quite different experience and skill sets, which are very complementary. So I'm certainly enjoying learning a lot about underwriting. So that question you asked earlier about how do you look at risks, I've found fascinating, because it's like going to a factory. You see how things are made. It's just different. You see how different risks within the built environment aggregate. So it's certainly interesting for me. And I think complementary because a lot of the solutions that are out there within the InsurTech landscape are, there's a lot of energy, there's a lot of entrepreneurs. Technology is very capable, but what's not always obvious is that they're being applied to the problems at hand. So being able to translate the priorities and the needs of underwriters into a language that energetic entrepreneurs and technology vendors can understand and build appropriate and targeted solutions is one where I think our combination together unlocks a very interesting potential, and so quite complementary. But really, it's very much defined by what exactly the underwriter is looking for. We're not purveyors of solutions. We're really looking to understand problems and open up the possibility of solutions because we know what's out there.
So could I summarize this and tell me if I'm too summarizing it? But John, you're the tech and entrepreneur type, and Tony, you're the underwriting expert. Is that something like that?
I think naturally that there is a sort of division of skills, but I think it's much more of a continuum than you are potentially making out there, Phil. Let me give you an example. For example, underwriting in the past has all been about, let's look at the historic profile of the risk and let's project that profile forward. Okay, that's classic underwriting of the 1980s, right? Can you project a natural catastrophe risk forward in the same way with the recent climate change that we are, I think, very much feeling and seeing?
Or cybersecurity.
Yeah, cyber, exactly. But I don't think it's just those sort of products. I mean, if you look at D&O, if you look at liability trend, there are so many changes going on now in the environment that actually you could become a slave to the past. In fact, it could be a tyrant. It could actually lead you to bad outcomes if you just purely trust the historic view. So John and I talk an awful lot about a sort of multiple current view of risk. So you're trying to get multiple angles on the current risk that you are taking on, rather than trying to always look at the historical record and trying to project on from that. And of course, that means you've got to grapple with a whole load of external data. Okay. That external data is only going to come usefully into your underwriting process if you've got good technology that enables that data to enter into your process in a meaningful way.
So if you have any concrete examples, I understand, okay, you look for, in the case, there were that many earthquakes in that part of the world, so you can project, that's the past. But how do you integrate these different new type of data? How do you structure this to have a clean process to improve your underwriting?
A lot of people are talking about ESG at the moment. So let's just walk past for a moment the fact that ESG itself is being defined at the moment. So I think we need to accept that there are multiple definitions of ESG out there and competing. But we are now starting to see people look at ESG data scores and take that into account when they're offering D&O coverage for their customers. So rather than relying on, well, we haven't had any claims against our directors and officers policy in the last 5 years, starting to take much more of an exposure view and saying, well, and their ESG scores are very strong. So it would appear that they've got very good environmental, social governance credentials in the present. And you might then want to look at, what is the Glassdoor score on this company? Are the employees happy? Let's look at the health and safety record of the company. Again, public data. Let's look at that and take that into account when we're assessing a D&O risk. Now, to get all of that data usefully into the underwriting process, you're going to need technology. Technology is an enabler of that, as John said earlier. It doesn't solve the problem, but it enables the problem to be solved. And therefore, if you are going to go to a state-of-the-art process for D&O insurance, and I would argue it's not just D&O, it's in multiple lines of business, then you've got to start looking at how technology, how new sources of data can facilitate that, can enable that. So I think it's much more complementary. It's much more of a continuum than maybe your initial conception of you do the underwriting and John does the technology allows.
So there will be a lot of changes needed. How did you train underwriters so far? And what do you think the challenges are in training the new generation of underwriters?
I think that's a great question. It's undoubted that the underwriter of the future, I mean, often seen as the bionic underwriter of the future, will obviously have to have different skills than the historic underwriter. Let's talk about that underwriter moving from being an art or an artist to being more of a quant and more of a sort of data analyst. There's a rough approximations. Phil, I still think you need a lot of the art in underwriting. For example, we talked about the importance of negotiation in underwriting. That is always going to be a human-to-human interaction, and you need to be able to draw upon all your creativity and other artistic sort of traits for that. So I think we need to make sure we don't get too enamored with the fact that everything's going to become an algorithm and it's going to be just a machine talking to a machine and that's the end of it. So I think we will see underwriters become more data aware, more data conversant. Certainly they'll be able to analyze data or have teams that support them with data analysis. And I think that is the way that the world is moving. But at the same time, I don't see it as moving from one state where everything was essentially poetry, poets working in their own sort of creative juices, through to a situation where it's literally quants. All they're doing is bashing numbers all day long. I think that underwriting will always retain a foot in both camps.
If I can just pick up something, and it's to one of the questions you asked earlier with the insurance industry and change. I think particularly when it comes to reinsurance and commercial insurance, one of the challenges around change, Tony named two, there was a third that I feel, is the processes are often annual processes. So if you think about new technology or tools, interfaces that you interact with, there's this idea within software development of continual development and integration, rolling out features every 2 weeks, 2-week sprints, and the product is continually improving. But for change to become sticky, people need to be interacting with features frequently. So if you're only underwriting business on an annual basis, your ability to embed change from a tooling perspective is limited. We at B3i would roll out feature updates on a quarterly basis, but frequently they would only be tested in anger once a year.
Right.
And so that feedback loop is quite slow. But one of the things, and I'm going to go to a very clear story that I experienced that I had, where I was speaking to two underwriters who underwrote a reinsurance program that was being placed over the B3I platform. And there was a 20-year age gap between them. One young underwriter and another one who was a few years from retirement. And they were being introduced to a new tool to administer this agricultural program. The resistance I felt from the one underwriter, the problem for him was that he needed to remember another password. And the younger underwriter said, oh, this is like Aon's AB Connect or Carpenter's GC Marketplace. Oh, I know how to use those. If I know how to use those, well, I know how to use this tool. And it was a very stark generational difference in the room. And at the end of the meeting, the elder underwriter did say, look, if this is the tool we're using, then I guess I have to learn how to use it. Change is slow, but the younger generation's familiarity with using technology, their ease of adoption of new tools is going to be a catalyst for significant change. So I do think there is hope yet, and there is a lot of innovation happening, and the slow pace of change is what's created such a huge opportunity within insurance. There is a lot of low-hanging fruit to improve things.
Yeah. So thank you for these optimistic words. I would like to take this opportunity to thank Steve Aurora, because he's the one who kindly introduced us to you guys. So Steve, if you watch this interview, thanks to you. Tony, John, is there anything else you would like to say for today?
Well, we could talk forever, so there's lots.
Yeah.
But it's been a pleasure to be here. Thank you very much, Philippe. Great experience. And what I would maybe add is if the listeners are interested in what we're talking about and want to talk further, we're very good listeners.
And Philip, I thank you obviously for the opportunity today to have a good conversation. And I look forward maybe in a year's time to sort of catching up. And my guess is we will be thinking differently in a year's time. In fact, if we're not good listeners, then that will be an acid test, because every interaction brings its own novelty. And one of my acid tests is, do I think differently when I go to bed than I got up in the morning? And I think that's a very, very important thing for us all to embrace in our industry. It's a great old industry, but at the same time, it's not going to be a great old industry much longer unless we continually challenge ourselves and want to do things a little bit differently tomorrow.
Great. Now, on these very wise words, I would like to thank you very much for this great discussion together. I've learned quite a few things here. Thank you very much, and all the best with your company. Take care.
Thank
Cheers.
you very much indeed.
Thank you, Philippe. Thank you, listeners. Bye-bye.